Okay, let's talk about the S&P 500, which just blasted past 7,600. It's an incredible milestone, right? But underneath this euphoric rally, things are getting complicated. Global oil routes are choked. The European Central Bank is gearing up for a shock rate hike, and a massive liquidity drain is literally looming on the horizon. So as central banks start heading in completely opposite directions, the real question we need to ask is your portfolio actually prepared for what's coming?
7,600. That is a massive eye-watering record high, mostly fueled by this explosive AI and tech boom. Okay, let's dive into this, because when we peel back the layers and look at the underlying macroeconomic data, we really have to question the sustainability of this rally. The headlines are out there screaming endless growth, but the bond markets, well, they are flashing some serious warning signs.
So how exactly does a record market high clash with surging global bond yields and an incoming commercial real estate crisis? It's kind of a perfect storm. Right now, this massive AI stock rally is essentially masking a severe credit vulnerability in the system. Surging bond yields and this absolute flood of corporate debt issuance are draining systemic liquidity, and that is a direct threat to global real estate and highly leveraged equity sectors.
To make sense of it all, here is our roadmap for today's explainer. First, diverging global monetary policy. Second, the AI CapEx debt boom. Third, real estate's refinancing wall. And finally, navigating the market volatility.
Real quick, just the standard disclaimer before we jump into the data. The information in this explainer is strictly not investment advice. Please always make your financial decisions based on your own personal risk profile.
All right, let's get into Section 1, Diverging Global Monetary Policy.
You know that era of synchronized central bank policy we got so used to? Yeah, that is officially dead. The rules of the game have completely changed. The biggest shockwave right now is coming straight out of Europe. The European Central Bank is preparing a shock rate hike to 2.25%. Why? To fight off surging 3.5% services inflation and energy costs. So even though their economic growth is weak, they are literally forced to tighten policy just to fight these entrenched price pressures.
And this dynamic triggers what we call a bear steepening in the bond market. Put simply, when inflation risks are running hot and the supply of new debt is heavy, investors aren't just going to hand over their money for free. They demand higher returns to hold long-term debt. That pushes long-term yields up, which fundamentally steepens the yield curve.
So we're seeing this stark, almost jarring divergence right now. You've got the U.S. Federal Reserve attempting to hold the line despite these massive fiscal deficits. But on the other side of the pond, the ECB is being forced to tighten monetary policy amidst real stagflation risks. This European tightening is acting like a magnet, pulling capital toward higher-yielding euro assets.